Hello and welcome back to the channel Compliance Lookup. In today's video, we will discuss part 3 of customer identification procedure and risk management. We'll dive deeper into how these procedures are implemented, the tools used, and the real world impact they have on businesses and individuals. If you found this video helpful, don't forget to like, share, and subscribe for more content on financial compliance, regulations, and more. Now, coming to our topic, what is customer due diligence? This is the standard level of verification done when a customer has no higher risk factors. It typically involves identity checks, address verification, and assessing the customer's financial status. Example: when a customer opens a savings account, the bank asks for a government issued ID, proof of address, and verifies the customer's signature. Woodell is simplified due diligence. For low-risk customers, like someone with a long-standing relationship with the bank or an entity with a low-risk profile, simplified due diligence may be sufficient. It might involve fewer checks than normal due diligence. Example: a customer with a long-standing due diligence account may not need to undergo the full range of identity verification when opening an additional account. The bank may perform simplified checks like confirming basic information and conducting periodic reviews. C. Enhanced due diligence. When a customer presents higher risk like politically exposed persons, high value transactions, or cross border activities, enhanced due diligence is required. This involves more thorough checks such as verifying the source of funds, checking against sanction lists, and understanding the customer's business activities. Example: a bank may need to perform enhanced checks when a high net worth individual opens an account for cross-border wire transfers, requiring them to submit additional documentation like tax returns, source of wealth statement. Now coming to next. D. Screening of customers. Customer screening involves checking the customer's details against lists of sanctioned individuals, politically exposed persons (PEPs), and adverse media reports. This is important for compliance with anti-money laundering (AML) regulations. Example: before opening an account for a new customer, a bank checks the person's name against international sanction lists to ensure they are not linked to terrorism or criminal activity. E. Field verification. This is the process of verifying customer information through physical visits or direct communication with third parties to confirm the details provided. Example: if a customer claims to own a business, the bank may visit the business location or contact the local chamber of commerce to verify the existence of the business. Now moving forward. F. Other modalities of customer due diligence. These could include video verification, using biometric data for identity confirmation, or using external verification tools just like we see in credit bureaus, government databases. Example: a bank might use biometric facial recognition technology when opening a bank account remotely, allowing the customer to verify their identity using their phone camera. G. Customer acting on behalf of others. In cases where a customer is acting as a representative for someone else, like a legal or financial proxy, additional verification is required to confirm the identity of both the customer and the person they are representing. If a corporate executive opens a bank account for their company, the bank needs to verify both the executive's identity and the company's registration details to ensure they have the authority to act on behalf of the company. H. Customer due diligence and its concerns. There are several concerns in the process of CDD, including the risk of missing critical checks, failing to identify politically exposed persons, PEEPs, or not verifying the source of funds adequately. Example: a bank might face issues if it neglects to screen a high net worth client's business background and later finds out the client is linked to illicit activities. I. Cases of customer due diligence. This refers to situations where improper or inadequate due diligence was done, leading to financial crimes or regulatory penalties. Example: a bank might face a fine if it failed to apply enhanced due diligence on a client linked to a politically exposed person, allowing them to make suspicious international transactions without proper scrutiny. These examples illustrate the importance of tailoring customer due diligence processes to the specific risk level and operational environment to prevent financial crimes and ensure compliance with regulations. Now, moving forward, Unique Customer Identification Code UCIC. The UCIC is a unique identifier assigned to each customer by financial institutions to ensure consistent identification across various systems and platforms. Example: a bank assigns a UCIC to each account holder. If a customer holds multiple accounts, savings, current, loans, the UCIC helps the bank link all these accounts to the same individual. This avoids confusion and ensures proper tracking of the customer's activities and history. Next is review risk categorization. This involves assessing the risk level of a customer periodically or when specific events occur. It helps determine the frequency and depth of reviews required for each customer. Let's divide it broad for better understanding. A. Periodic review. It refers to regularly scheduled assessments of the customer's profile and activities to ensure that their risk categorization remains accurate over time. Example: a bank reviews the profile of a customer every 12 months, checking their transaction history, updated documents, and any changes in their risk status, like political exposure, source of wealth. If no significant changes are found, they keep the customer in the same risk category. B. Event-Descent Review. An event-descent review is triggered by specific events such as suspicious activity, changes in the customer's circumstances, or the occurrence of certain regulatory events that could affect the customer's risk level. Example: a customer has a steady account history, but one day they suddenly initiate a large international transfer. The bank then assesses the transaction's legitimacy, checks for any links to high risk countries or individuals, and evaluates the customer's updated profile to adjust their risk categorization. Now, coming over next topic, periodic KYC updation. It involves regularly updating the KYC know your customer details of customers to ensure that the information is accurate, relevant, and up to date. This process helps in compliance with regulatory requirements and mitigates risks. A. Periodicity. The frequency of KYC updates depends on the risk profile of the customer and regulatory requirements. Example: a bank may require individual customers to update their KYC information every 5 years, while B. KYC updation requirements. KYC updation involves revising the customer's information, including identification documents, address proof, and financial details. For example, if a customer moves to a new address, they must provide updated address proof and possibly update their phone number or email address with the bank. C. Individual customers. For individual customers, periodic updates involve verifying personal information, address, and occupation to ensure they are accurate. Example: a customer needs to update their proof of address if they change residences and provide a new photo ID if their previous ID expired. D. Customer other than individuals. For non-individual customers like companies, partnerships, the KYC process involves verifying the company's registration details, owners, directors, and business activities. Now, first, no change in KYC information. If there is no change in the information, the customer's profile can be updated with a simple confirmation of details. Example: a company has not changed its ownership or business address. In this case, the bank simply confirms that no updates are necessary. Second, no change in KYC information. If there is a change in the customer's details, such as ownership structure or business address, those changes need to be documented and verified. Example: a business changes its registered office address. The bank requires updated proof of the new address and possibly updated corporate documents. E. Additional measures. Additional verification measures may be needed in certain cases, such as verifying a customer's source of funds or checking against international sanction lists. Example: if a customer is flagged for high risk activities, the bank may request additional documents such as proof of the source of funds or perform more detailed checks. F. Adopting higher level measures. If a customer's risk profile changes, like becomes a PEP, the institution may adopt enhanced due diligence measures and update the KYC accordingly. Example: if a client is identified as a politically exposed person (PEP), the bank may increase the frequency of monitoring and conduct a more thorough review of their transactions. G. Requirement of PAN. For Indian customers, PAN is required for opening certain accounts or performing specific transactions, and it must be updated regularly to ensure the information remains correct. Example: a customer must provide their PAN when opening a bank account, and if there is any change in their PAN information, like name change, they must update it with the bank. So we have completed the part 3 and chapter of customer identification procedure and risk management. If you want to get update of next topic, then please press bell icon of this channel. Thank you so much for watching this video.